Thank you for joining us at XM.com. You're watching today's Daily Market Comment by Haralan Bospisuros. I'm Christina Marujas. The U.S. dollar outperformed every other major currency yesterday, despite U.S. data adding to worries about the U.S. economy and prompting investors to increase bets with regards to rate reductions by the Fed later this year. Initial jobless claims for last week jumped to a 1.5-year high, reviving concerns that the labor market may be losing steam, although April's jobs report pointed to a still healthy state. Combined with a slowdown in producer prices, this allowed investors to add to their rate cut bets. So why did the dollar rally in the midst of bolstering rate cut bets? Perhaps it has fallen to levels that made it attractive to investors looking for safety, especially those concerned about the ongoing stalemate in the U.S. Congress over raising the debt ceiling. With Treasury yields coming under pressure and investors anticipating 3/4-point cuts this year by the Fed, at a time when the European Central Bank and the Bank of England are willing to continue hiking, calling for a trend reversal in the U.S. dollar still seems premature. Thus, any further recovery may be a corrective wave within its broader downtrend. For a bullish reversal to start being examined, the Fed may need to disappoint market expectations by delivering another hike in June, or by keeping interest rates untouched beyond September, when the first 25 basis points cut is fully priced in. Yesterday, the Bank of England raised its benchmark rate by 25 basis points, as it was widely anticipated, with the forward guidance staying more or less unchanged, so the spotlight was thrown on the upgraded inflation projections and the GDP forecasts, with the bank abandoning its call for a UK recession. Blending this with Governor Bailey's remarks that they must stay the course to ensure that inflation falls back to the 2% objective, investors were allowed to maintain bets of more rate increases in the months to come. Despite not being able to hold on to its decision-related gains, the pound could still perform well against its U.S. counterpart due to the divergence in monetary policy expectations between the Bank of England and the Fed. The risk-aversion mood was also reflected in Wall Street, with both the Dow Jones and S&P 500 ending their session in the red. However, the tech-heavy Nasdaq closed 0.18% up, adding to the view that high-growth investors are willing to stay in the market due to expectations of lower interest rates in the quarters and years ahead, pushing present values up. Yes, recession concerns are negative for stocks, but liquidity and expectations of aggressive rate cuts later this year are acting as life jackets. It seems that investors are confident that if the Fed decides to cut interest rates as they suggest, a recession can be avoided. This was a Daily Market Comment here at XM.com. Have a great weekend.